What I'd like to do now is introduce our morning keynote speaker, and I'm really pleased to announce that our speaker will be John Williams of the Federal Reserve Bank of San Francisco. John is the President and Chief Executive Officer of the San Francisco Fed, a role he has served since March of 2011. He began his career as an economist at the Board of Governors in 1994 and has an AB from the University of California at Berkeley, a Master of Science from the London School of Economics, and a doctorate in economics from Stanford University. Please join me in welcoming John.
Well, thank you. It's great to be here. Actually, this conference is pretty unique in the way it brings together academics, researchers, practitioners, community bankers, obviously regulators. And I think one thing we do know is in the Federal Reserve that we need to have this dialogue and communication across the different groups. We learn from each other, and I think this is a great example of that. I'm going to talk about interest rates a lot. I'm actually going to talk in deep dive into interest rates. So I hope you all poured yourself a really big cup of coffee because we're going to go well into a topic of interest rates. Obviously, you may ask, why am I going to focus at a community banking conference on the future of interest rates? And I think a couple of reasons. First of all, interest rates are my favorite topic. I love thinking about them. I like writing about them. And it actually has something to do with setting them. So that's one reason. But second, obviously, it's a topic that's of a great concern for banks, for our economy. And I think there are misperceptions out there about where interest rates are going, when we're going to raise interest rates, and how high we're going to raise interest rates. So I thought for this group, it's actually a pretty important, and I think hopefully you'll find an interesting topic to discuss today. So in thinking about this, I'm often talking to people, and quite honestly, a lot of community bankers over the years, and the narrative I've been hearing goes like this. Well, once the economy gets better, once interest rates rise, then I'll be able to do A, B, or C. And it's absolutely right. Post-financial crisis, the economy is improving. We've come a long ways back in terms of the economic recovery, and interest rates are rising. But I think an important part of the story, though, is that where interest rates are rising, the economy is changing to what potentially is a very different new normal from what we saw in the past. So that's what I'm going to be talking about, is what does this new normal look like for the economy and for interest rates, and dive into that. Now, I've already said interest rates, I think, 12 times, so time for the disclaimer. Everything I say today reflects my own views and doesn't necessarily reflect the views of anyone else in the Federal Reserve System, including my esteemed colleague who spoke here yesterday. So just got that out of the way. So let's see, now that I've kind of got this introduction out of the way, let me just say that there's good news here about the economy. So the U.S. economy continues to grow at a moderate pace. We're actually in the 9th year of the economic expansion. So this puts this expansion kind of in the short list for the longest expansions we've seen. And we've seen continuing good growth and improvement in the economy. And it's in that context of an improving economy that's come back from a deep recession that the Fed has started to raise interest rates and normalize monetary policy. But that, of course, begs the question, what does it mean to have normal monetary policy? What does it mean to have normal interest rates? So for many people, in my conversations over the years, many people, when they think about normal, they hearken back to the kind of go-go economy of the 1990s, early 2000s. When you think about when interest rates may have been above 4% or even higher than that. And so I'm just going to speak truth here. Like the pager, like the Walkman, and hopefully like the Macarena, we are not going to see interest rates on average as high as we saw in the past. So the bottom line here is, I think for bankers, but quite honestly for everyone, we are going to have to become accustomed to and plan for a world of moderate growth and relatively low interest rates. So let me give you a quick roadmap of what I'm going to cover. First, I'm going to talk about something that economists like me like to call R star, which is the notion of a normal interest rate that things tend to gravitate to over time. I'm going to talk about growth. I'm going to talk some about inflation and employment. And I'm going to talk about some new research that we've been doing at the San Francisco Fed that tries to help us and I think actually gives us some pretty good insights about why inflation has stayed so low despite the strong economy and strong employment. And then I'm going to talk at the end a little bit about the Fed's balance sheet and what that means for longer-term interest rates. Again, for bankers and for the economy, it's not just the short-term interest rates that matter. Obviously, it's the longer-term interest rates. That's a lot to cover in the amount of time I have, but I promise I'm going to leave a lot of time in this session for Q&A and for this discussion. So I'm looking forward to all of that. So let me talk now about R star. So R star is what economists call what we call the natural rate of interest. Again, it's this concept of what the interest rate will be when the economy, in the future, when the economy is at full strength and kind of in a steady state. So it's a nice concept to think about what's normal in the long term. It's also something that we use to think about monetary policy, because you think of monetary policy relative to this. Importantly, R star is something that's, even though the Fed and other central banks set short-term interest rates, this concept of R star really reflects fundamental factors on the supply and demand of the economy that are outside the control of monetary policy. So these are things I'll talk some more about in terms of trends in demographics and growth. So the key change here, the key finding that we've seen in recent years is that this level of this natural rate of interest, or R star, has come down dramatically in the United States. And quite honestly, in the rest of the world, this notion of what's the new normal for interest rates. So economists tend to think of this in terms of a real or inflation-adjusted interest rate. And so when I think of the Fed funds rate, what's the new normal for the real Fed funds rate, I put that about 0.5%, 0.5%. Now, if you think about that in terms of nominal interest rates or normal, regular interest rates, and the Fed has a 2% inflation target, so once in the future when inflation is about 2% and you add this 0.5%, that means a normal federal funds rate would be about 2.5% in this world, which is, if you think about it, it was much lower than a normal interest rate at any time in the last several decades. In fact, if you compare this view of what a normal interest rate is to about 20 years ago, that's about 2 percentage points lower. So back in the 90s and early 2000s, I would have said that the normal interest rate was about 4.5%, and today I'm saying 2.5%. Now, importantly, this isn't unique to the United States, and this isn't only driven by events in the United States. If you look across the globe, you see this decline in the new normal for interest rates in all the countries we've studied. So if you take the average, for example, in other major economies like Canada, the Euro area, the United Kingdom, and Japan, the estimate of the real R star, or natural rate of interest there, is actually a little bit below this 0.5% that I put out for the United States. So again, this is something that's a long-term development expected to last into the future and is also not just something about the US. So the question naturally is, what's going on? Why is this new normal interest rate so much lower than what we saw 20, 25 years ago? And so economists have looked into this and studied it in depth and identified a number of factors that are pushing interest rates down for a long time. But I think the most important one is actually a slowdown or a decline in the sustainable growth rate of the US economy. And the same thing I'll just mention is happening in many other countries. So we're seeing the sustainable growth rate of the economy slow in the US, and in fact, my own view of this is that on a real GDP basis, that our growth rate in the future will average about 1.5%, again, thinking of a long-term average. So 1.5% growth for real GDP is the lowest number I've seen in my lifetime, much lower again than we saw in the 80s, 90s, or early 2000s. So what's driving this slowdown and this potential or sustainable growth of the economy? And here are two factors are in play. Basically, it's a demographics, a slowdown in labor force growth, and second, it's a slowdown in productivity growth. So let me take each of these in turn. So in terms of the demographics, we have, in the US economy especially, we have the baby boomers retiring in droves, so that's slowing labor force growth. Second is fertility rates in the United States have been coming down for decades and are actually very low levels today. So going forward, if you think how much is our workforce going to grow, that's about 0.5% per year in the future, which is about a third of what we saw back in the 1980s. So that's one factor that's slowing growth. Now, I will say that as a monetary policymaker, the one thing you always have to remind yourself is the limits to monetary policy, what we can and cannot do. And so it really is outside the scope of monetary policy to affect how many babies people are having. So we can't change that. We have to accept that as it is. Now, turning to productivity growth, we're seeing a similar pattern of a slower productivity growth today than we saw back in the past. And that reflects a number of developments in the U.S. economy, and we've studied that a lot. Obviously, productivity growth depends on investments, business and public investments in infrastructure and in education, research, and development, and a lot of different things, but when you look at the data, productivity growth today is hovering about a little under 1%, and that compares to about 2 to 3% per year that we saw back in the 90s and early 2000s. So a pretty dramatic decline in this trend growth rate of productivity. Now, I have some of my own ideas about how we could improve productivity. For example, in the San Francisco Fed, I know that productivity would grow by leaps and bounds if we didn't have all these hipster cafes around in our neighborhood and people weren't taking a half hour to get coffee. But I can't control that at the Fed. That's outside our policy remit. But it does have, important implications of the new normal for growth is moderate growth, and that plays into a lower neutral interest rate as well. So what are the key implications of this new kind of normal for growth and in interest rates? And so first of all, for banks, the new normal is a slower growing economy. That means slower lending growth, lower profit growth overall, and obviously lower interest rates has effects on profitability and business models. But taking a step back from a monetary policy perspective, which again I think is important also for the financial industry, take a step back, a lower normal interest rate means that the Fed, and quite honestly other central banks around the world, will just have a lot less room to cut interest rates if there's another recession. So historically in the US, during a recession, the Fed would cut interest rates by 4 or 5 percentage points, depending on the situation, in order to stimulate spending to get the economy back on track. And that's worked in the past because normal interest rates were higher. Well, if you think of a future normal interest rate of being 2.5% or something, obviously that truncates or limits the ability of the Fed to react to the next recession. The implication of that is, if nothing else changes, future recessions will probably more likely be met with unconventional policy actions, the kind of things we've seen in the last 8 years. That's using the Fed's balance sheet to get longer term rates down, keeping interest rates low, very low for a very long time. And I dread to even say this in this room, but even possibility of negative interest rates, which we've been seeing many countries have to resort to try to stimulate their economies during prolonged downturns in this world of a very low R star. So I appreciate you listening to my kind of big picture, 60,000 foot view of what the long-term long-term view of interest rates in R star. But let me get now into a little bit of what's happening in the economy and how that's going to affect how we get to this new normal of interest rates. So I'm going to talk about growth, inflation, and employment. So in terms of growth, my own view is we've got good momentum. The economy continues to grow, and despite the human tragedy of the hurricanes, I do believe that the U.S. economy will continue on the path that it's been on and continue on track in terms of expansion. Thinking about growth going forward, I expect it to be on the same moderate path we've seen the last couple years. And when people hear moderate growth and they see we're going to say more of the same, they often find this is a disappointing view of the economy, growth of around 1.5% to 2%. But again, I want to remind you that there's this new normal of what the sustainable path for the economy is, what our potential is to grow, is again something like 1.5% real GDP. So you always have to think about, what is our growth relative to the sustainable economy. And here, given where the economy is today, a concern is if the economy were to grow too fast going forward, that would create imbalances like an asset price bubble. We've seen that all in our lives, or a high inflation or some other challenge that would threaten the economic expansion and our economic health. And from a monetary policy point of view, what's really important here is to basically try to minimize the risk of the economy creating these imbalances and having these negative effects. It may eventually lead to recession. I always put it very simply, the goal for monetary policy in this in this situation is just to try to keep the expansion going as long as possible. And the way to do that, you want it to be on a sustainable basis. So that's the view on growth that I have. Turning to inflation, I have to say I do feel the agony of Sisyphus, who, as we rolled up this ball of inflation up to our nearly our 2% goal earlier this year, watching it roll back down on us as inflation has come down. And you know, there's been a lot of commentary of late about why has inflation been so low, given that the economy is growing well, given employment and other things. And recently, the Financial Times commented that the Fed was baffled by the low inflation. Now, I want to put this in a little bit of context. First of all, the inflation measure the Fed looks at the most has been running a little under 1.5% over the last year. So that is below our 2% target, and it has been below our 2% target for most of the last several years. But you know, when you think about what's happening with inflation, just first of all say in response to the FT, Fed economists are rarely baffled by what's happening in the economy. But importantly, when we do see data that it doesn't align with what we were expecting in our models, what we do is we roll up our sleeves and try to figure out what's going on. So I'm going to talk a little bit about some research that we've been doing at the San Francisco Fed that I think helps us understand why inflation has been low despite the fact that the economy is actually doing well. So the basic idea of my colleagues was to split the consumer basket, if you will, into two categories. So one category for one where the prices tend to be sensitive to the economy. When the economy is strong, those inflation rates go up. When the economy is weak, they go down. They're the more cyclical aspects of the goods and services we buy. There are other categories of things we buy that just tend not to move up and down much with the business cycle, but really get affected by things that are more idiosyncratic to that industry or sector. So we separate these out into these two categories. Well, if you look at this first category, the prices of goods that typically move up and down with the economy, the ones we think of as being how monetary policy affects inflation, what we've seen is that the inflation rates for those goods and services have risen as the economy strengthened, actually back to more or less the levels they were at before the recession started. So no mystery there. For the inflation rates that we normally expect to move with the economy, they're back to where we would expect them to be. But this research also highlighted some other very interesting findings. One is in these goods and services that typically aren't as sensitive to the economy, well, there we've actually seen some significant declines or weakness there. Specifically, we've had some big price declines on cellular phone service, some pharmaceutical prices, airfares, things like that. And digging deeper into the data there, what we find is those prices tend to be volatile, they go up and down, and they tend not to have a lasting effect on inflation. So part of it is just the fact that, you know, in a dynamic economy, prices are changing. So I don't expect that to have a lasting effect on in inflation. But the third finding, which was I think the most interesting and maybe novel, is that one of the areas where inflation has been very low is actually healthcare services, which may be a surprise to many people who think of that as an area that's been high inflation rates. For the last few years, actually, inflation in healthcare has slowed pretty dramatically. And so again, when we don't understand what's going on, we dig deeper and deeper. And what we discovered was that in that category, the legislated changes in Medicare and other payments to providers over the last few years dramatically cut the prices paid on Medicare to doctors and hospitals. But also the way this works is those price declines tend to get passed on also to private sector providers and doctors and hospitals. So we've seen this kind of legislation to lower healthcare costs for Medicare spill over into more broader prices for healthcare. And that's actually knocked off about 0.3 of a percentage point from the overall inflation rate over the last year. So understanding why inflation is low is really important for thinking about where it's going to go over the next few years. So from my point of view, some of these price movements are basically noise. They tend not to stick around for a long time. The healthcare, those effects will probably continue for a while. But looking ahead as these various effects wane, and importantly, this strong U.S. economy, which is, as we've seen over history, tends to move up inflation rates for those goods and services that tend to be more sensitive to the economy. We're going to see those inflation rates rise. I'm confident that we're going to see us get to our 2% inflation goal in the next couple years. Now, turning to employment, the Fed has two goals, maximum employment and price stability. I've talked about price stability, that's the inflation part. In terms of employment, economists tend to think of whether we're at maximum employment in terms of the unemployment rate in the economy relative to what we would think of as a natural or normal unemployment rate. Now, you may be shocked to hear after my long discussion of R-star that we tend to call the natural rate of, or normal rate of unemployment U-star. But I'm not going to have time to talk about U-star today. And it's hard to know exactly what the normal unemployment rate is, but I put it around 4.75%. So if you think about that today, the unemployment rate's 4.4. That means we've reached our full employment benchmark, and in fact have exceeded it by a fair amount. And I think even more importantly, looking forward, given where I see the economy going, given this job growth we've seen, I expect the unemployment rate to continue to come down in the U.S. economy to below 4% next year. That's the lowest unemployment rate, by the way, if you're going back in history. So in my lifetime, the only time we've reached unemployment rates below 4% would be at the end of the 60s and again at the end of the 90s. So if you're thinking about long-term perspective, this is a very strong labor market relative to history. So putting all of this together, moderate growth, inflation moving back to 2%, and a very strong labor market that continues to strengthen, these are all the factors that are arguing for the need to move interest rates, short-term interest rates, back up to the new normal. It's something the Fed has already started undertaking. So that brings me to, as I said, the last topic that I've come to, and that's longer-term interest rates in the balance sheet. In the financial crisis, in the recession, in the recovery, the Fed bought trillions of dollars of long-term treasuries and mortgage-backed securities. The goal here was pretty straightforward. We wanted to lower long-term interest rates, so we had lowered short-term interest rates to zero. We want to get long-term rates down, mortgage rates down, other car lending rates down, to give the economy an extra boost. I think that was effective. It helped the economy grow out of the recession. But again, in the context of an economy that's improving, at full employment, inflation moving closer to our goals over the next couple of years, we are now starting the process of unwinding that accumulated balance sheet. We're going to do this gradually, and we expect over the next several years, we also expect it to gradually push up longer-term interest rates as we undo the effects the beneficial effects on long rates that we saw in previous years. So, what does this mean for long-term interest rates, and how do we think about what the new normal there is? Obviously, for bankers, for the economy, long-term interest rates and the spread between short and long-term rates is a key ingredient in thinking about bank profitability. So, in thinking about there, I think the question comes to mind is there a new normal for long-term rates relative to short rates? And I think that there's reasons to think that there will be. But first you have to kind of think about what are the major factors that are influencing long-term yields today. The first is the Fed's balance sheet. Estimates by Fed economists suggest that our holdings from our various QE programs are pushing down 10-year Treasury note yields by a little less than 1 percentage point. So that's having a very major effect on the long rates today. As we unwind the balance sheet gradually over the next several years, that downward pressure on long-term rates will also unwind. And so that will push long-term rates up relative to today. The second thing to think about here is that I think that in the past, these spreads between long rates and short rates, so if you take a 10-year Treasury versus a Fed funds rate, the average historically before the crisis was probably about 1.5 percentage points, depending on what period you look at. That reflected a number of factors, including a long decline in interest rates over the last 30 years. So looking ahead and thinking about what the spread between long and short-term rates are, I think there are reasons to believe that we're not going to return to this high level of spreads of something like 1.5 percentage points, but the new normal is probably something lower than that. Now, I don't have a crystal ball. I can't make predictions about where long-term rates will be, but going through this kind of analysis and crunching the numbers seems like a reasonable, educated guess for a normal, future spread between a 10-year Treasury and a Fed funds rate would be something close to 1 percentage point. In fact, if you look at the Blue Chip Economists survey, and they're asked about long-run forecasts, they come up with a number similar to that. So doing a little interest rate math here, that means with a Fed funds rate of 2.5% being the new normal, it means a long-term, like 10-year Treasury, that's probably something like a 3.5% plus or minus. Of course, again, remember the comment about the crystal ball. So, ladies and gentlemen, I mean, I just want to summarize that the Fed is moving to more normal interest rates, more normal monetary policy, both on the short-term interest rates and also on our balance sheet. But this is in the context of a new normal that's very different than the past. Lower R star, lower trend growth mean we need to all prepare for a very different world. So for all of those who've been still listening to your Walkman, you might think about getting yourself a smartphone. And all those who are expecting interest rates to go back to 4.5%, I think the reality is that we're likely to have a new normal of short-term interest rates of 2.5%. And we all, bankers, regulators, everybody, needs to adjust to what this new normal means. That is until the data tell us something completely different. But thank you.